Okay, so today, obviously, as Rick just said, I'm giving a presentation about the Jobs Act, which is, we'll go into more detail, obviously, but it's simply just another piece of legislation that has significantly affected the access to capital for companies in both the private and public space. So we're just going to talk about that. Okay, so just a quick overview. The JOBS stands for Jumpstart Our Business Startups Act. It was signed into law on April 2012 by President Obama, and it received overwhelming bipartisan support. So similar to, we've actually seen an amazing amount of bipartisanship with the COVID response. Well, the Jobs Act had a similar degree of that. And it was the kind of ultimate goal, and why it was put into place was it was designed to help smaller businesses raise more capital. And ultimately with the goal of, if more small businesses have more and more access to capital, small businesses can grow, which will ultimately stimulate job and economic growth. So it was just seen by Congress as a way to try and spur the economy following the 2008-2009 financial recession, just to make businesses raising money a little bit easier. So if we go into this chart, this is one of the first things that, if you notice over time, so the blue represents the number of the percent of IPOs that have come from what are called small cap businesses, basically where the IPO was valued at less than $50 million, where the gray shows the percent that was more than $50 million. And so if you look at the first kind of leading up to 2000, and this chart could go further back, but it's just too much data. But we see that for a long time, most, or at least about half of all IPOs were small companies. And there was this kind of trend historically that you would, once a business, it would grow, it would get to a certain point, and then once it got to a point where it really wanted to expand, it would go into an IPO, and then it would enter the public markets and all of that. And then around 2000, we just talked about this in our chat, we see the dot-com burst, and at the same time we saw some accounting scandals that led to the passage of the SOX Act, which I assume would have been mentioned in the last presentation if Fred was here. But basically it was just an act that pretty heavily increased regulation on public companies. So it made it significantly more costly in terms of being a public company. And so following that, and for a variety of reasons, we see that leading up to 2012, most IPOs were performed by large companies, and all these small companies were avoiding going public, partly because of too much cost and partly because of a bunch of other reasons. And so right here in 2012, one of the purposes of Jobs Act was to help make it easier for smaller companies to go public, which I'll talk about just in a second. But we do see that since the passage of Jobs Act, the percent of small companies going public has increased to where it was the highest it's been since the dot-com bubble. So it's possible that the Jobs Act actually did help with that. And so the way in which the Jobs Act sought to increase or incentivize smaller companies to go public is it created a new class of companies called emerging growth companies, which basically just means it's companies with less than $1.7 billion in revenue. And so as long as you had a company, your company had less than $1 billion in its last fiscal year of revenue, then it would be considered an emerging growth company. There are some other disqualifiers. For example, if you have over $1 billion in non-convertible debt, then you're not an emerging growth company. But basically, mostly it's the revenue. And so some of the advantages that these companies have that don't belong to larger companies is they're allowed to test the waters before an IPO. So historically, since the Securities Act of 1930 something, it has been companies could not interact with investors before submitting the fact that they were going to go public. So you could get in serious trouble for what's called gun jumping, which is basically meant you can't go and start networking with investors before you let the world know you're going public. And what these companies are now allowed to do is they can meet with institutional buyers. So if you think of like mutual funds, you think of these very large funds of institutional investors, they're allowed to meet with them and do a roadshow beforehand to test whether there is actually interest in their stock before deciding to publicly list it, with the idea that most investors in today's marketplace are institutional buyers. And so there's an incentive to see if the main investors are actually interested. And so if once an emerging growth company to test the waters and they say, hey, look, it looks like there's enough institutional desire for our stock in the market, they're allowed to submit a confidential draft of their S1, which is basically just the filing thing saying they're going to do a public offering, IPO, which I think we talked about last class. And so again, before, and for companies that aren't emerging growth companies, when a company decided they wanted to start an IPO process, they'd have to submit an S1, and that would become immediately publicly available so that investors and a company's competition immediately knew that it had the intention to do an IPO. What these companies are allowed to do is they're allowed to submit a draft confidentially to get it back with, and the SEC will tell them if they have any material adjustments that need to be made, and then they can re-amend that, and then they can submit it publicly if they decide to do their IPO. If they end up deciding to pull out, then no one will have ever known they were starting the process of an IPO. So again, it's just another incentive. And then on top of that, when they actually do decide to go through with their IPO, there's a lighter initial disclosure of information they have to present. So for example, normally a company has to do 3 years of audited financial statements. And for emerging growth companies, they only have to have 2 years of those financial statements. And then for the first 5 years that they are a public company, they're allowed to ease into the full cost and to follow all the rules set up by SOX and all other regulations. So for example, they have less, like their executive, they don't have to reveal as much about executive compensation. And they have to still have audited statements, but they don't have to have an audited attestation of internal controls where other companies have to. And there's a bunch of stuff, but basically it just makes it so that instead of going straight from being a private company to being a full public company with a huge amount of regulatory burden, they're allowed to ease into that. And so, like, if we go back to this other screen, it seems plausible that the Jobs Act did a decent job in incentivizing enough of these emerging growth companies to go public, and maybe they wouldn't have without this act. Kind of hard to tell. But then another major part of the Jobs Act, was it helped significantly with private offerings. So this graph here on the left, this shows since 2009, this top line is the amount of exempt offerings, which just basically means private offerings where you don't have to become a public company. Where this bottom line shows the amount of registered offerings, which is basically IPOs and secondary offerings of a public company. And so we can see that, when we think about investing, we often think about the having large, we think about public, but actually the market for private companies raising capital is fairly significantly larger almost twice as large as public offerings. So we're going to look into some of, and then over here to the right, this shows the main type of private offerings that are allowed, and we're going to talk about some of these because the Jobs Act helped with, it made some new rules for a bunch of these offerings. So we'll just go into all of those in a second. But so this is just to show that while we often first think about the public market, the private market for raising money is actually fairly substantial. So one of the things that the Jobs Act did is it improved something called Regulation A, and now it's sometimes referred to as Regulation A+. So before the Jobs Act, Regulation A was an exemption, so public, that a company could use to raise money. There weren't two tiers, there was just one tier, and the most a company could raise was $5 million. And so Jobs Act came in, it made two tiers, so two separate offerings, and it raised the amount a company was allowed to raise while still being able to use this. So with tier 1, a company can raise up to $20 million. There are no investor restrictions, which just means anyone is allowed to invest. And there's no ongoing reporting. So they get to stay a private company 100%. They don't have to make any annual reports or anything like that. But the main disadvantage to tier 1 offerings is that they are subject to blue sky laws. And so completely not related to the blue sky thing talked about in the last presentation. Blue sky laws basically are just security laws that are instituted by a specific state. So it just means that, if you want to offer your offering in California, California has laws that you have to adhere to that the SEC itself doesn't require. And so if you're doing a tier 1 offering, you have to follow different rules for every state that you intend to raise money in. But what it created a tier 2 offering where this is sometimes called a mini IPO, which we'll talk about why. But a company is allowed to raise up to $50 million if they do this. They're exempt from those blue sky laws, so they can file in whatever state, and there's they don't have to follow any of the local state laws. There are restrictions on non-accredited investors, so there's only a certain amount that non-accredited investors are allowed to invest in. So basically this one's mostly intended for accredited investors, which, have we already talked about what an accredited investor is compared to a non-accredited investor?
We have not, Jaden, and you may want to spend a moment doing that.
Okay, that's what I figured. So an accredited investor is basically, it just means someone who is thought of to have enough acumen with investing and enough resources to take on more risky investments. So I think right now the rule is you have to either have a net worth greater than $1 million, so your assets compared to your liabilities is greater than $1 million, or you have to have annual income, I think over $200,000 for the last 2 years. So basically an accredited investor means it's someone who's allowed to take more risks in investing because they have more financial resources that if that investment goes south, it's not going to, ruin their whole life. That's at least the thought. And so private offerings are the private market is often seen as much more risky than public ones. And so you're going to see a lot of these regulations are geared towards accredited investors just because they're allowed to take a little more risk. So tier 2, it's mainly focused on raising money to accredited investors. But then the reason this tier is called a mini IPO is because there are annual and semi-annual audit public reporting required. So it's not a fully public company. It doesn't have to adhere to all the rules that a fully public company has, but unlike any other private company, it does have to submit annual and semi-annual statements to the SEC, which are made publicly available. So Jobs Act this is the first time we've seen this half public company, where it's still not fully public, but it's also not fully private. So kind of interesting. And then if we come to this next graph, this just shows the fact that Regulation A beforehand, and I'll talk about 504 in a second, but Regulation A beforehand had very little activity. And then since it was the Jobs Act, it came into effect for Regulation A in 2015, we have seen a steady increase in the amount of companies who have been using this, with with about 60% of companies who do Regulation A doing that tier 2. So we're seeing, close to probably about $750 billion raised in 2018 under this Regulation A that was amended during the Jobs Act. Rule 504 we're not going to talk about because it wasn't directly impacted by the Jobs Act, and we see this huge spike, but this spike basically just came because there was something called Rule 505, which the SEC got rid of a few years in 2016. And basically 504 and 505 just overlapped. So when 505 went away, most companies that were using that just turned to 504. So this is kind of this came at the expense of something else. So it's kind of a not full description of a huge jump. And then there's something called regulation crowdfunding that we're going to talk about. But I just wanted to show you this before we go. It has barely been used. So it was a big thing with Jobs Act, but it's not, you can't raise that much money with it. Okay. Okay, and then so Rule 506, this is the most commonly used offering by private companies. And I'll just skip to this real quick. So this is Rule 506. It is used more than all other exemptions combined. So this is a very substantial way that companies use to raise money in the private market. And what the Jobs Act did is it created this second Rule 506C. So Rule 506B existed before the Jobs Act, and then the Jobs Act created Rule 506C. And so what Rule 506 does is one of the reasons it's used so often is because there's no limit on how much money can be raised. So a company can raise, up to an infinite amount of money without having to go public. They're allowed to raise money, an unlimited amount of money from accredited investors, meaning that, that definition of those who are allowed to take more risk, they can invest as much money as they want. And they're allowed to offer their stock to up to 35 sophisticated but non-accredited investors. So the idea here, and it's kind of hard to track, but it's basically a sophisticated investor, someone who has investing experience, but they don't have enough resources to be considered accredited investors. So they are allowed to do a few of those. But there's no solicitation allowed. So a company is not allowed to advertise their offering. They're not allowed to let the whole world know they're offering. They have to go find people specifically and keep track of who they've offered the stock to. So kind of burdensome. So in an effort to lighten that load, the Jobs Act created this second half. It also has no limit, so they can raise as much money as they want. Similarly, they can raise to an unlimited amount of accredited investors. However, they're not allowed to offer it to any non-accredited investors, and they must take steps to reasonably verify that anyone who purchases their securities is an accredited investor. So like if you're using 506C and someone wants to buy your stock, you have to take some steps to verify that they have the resources to be considered accredited. But what it did allow is for general solicitation. So when a private company is wanting to do a 506C offering, they're allowed to advertise that to the world. They just have to ensure that no non-accredited investors invest. And so since the Jobs Act, we've seen 506B, the first offering, continue to be used often. And then this is the law that was instituted, the one where they're allowed to solicit. We've seen it go up a little, but it hasn't been used quite as much. And it's speculated that that's mainly because of the steps to have to accredit investor, to verify accredited investors. Because, yeah, so we'll just move on from there. And then the next, and this one possibly received the most attention from the Jobs Act because it was such a new concept to securities law that had been totally 100% outlawed up until the Jobs Act. But I'm sure you guys have all heard of crowdfunding. The general definition of crowdfunding is just raising money via the internet. So we've seen crowdfunding used for like raising money for like nonprofit type stuff, and for charities have used crowdfunding for a while. And so the Jobs Act made it legal for securities offering. So they can raise money, a company can raise money via the internet. And one of the things that makes this so interesting is anyone is allowed to invest in a crowdfunding capital raise. So, your grandma, me, anyone in the United States is allowed to invest in these. So it's the general public, where, like we just said, most private offerings, you have to be a wealthy investor. This was intended to help the middle class get more involved in private investing. However, with that being said, there was serious concern about people scamming significantly from crowdfunding. And so the SEC has put some serious limitations on how this is used. The max a company can raise in a 12-month period is 1.7 million. So again, this isn't going to replace an IPO. This isn't going to kickstart a company from 500 million in revenue to $1 billion in revenue. This is meant to help startup companies, to help entrepreneurs get ideas off the ground so that they can start growing, and it maybe eventually lead to an IPO. But this is really geared towards kind of like angel investing, almost geared towards those small companies. And then the amount that one individual is allowed to invest is significantly limited based on their income. So it's just the max you're allowed to invest is a certain percentage of your yearly income or net worth. So again, you're not allowed to invest very much. The company is not allowed to raise a lot, but there is general solicitation allowed. So again, obviously, if you're going to try to get the general public to invest in something, you have to solicit to people, but it is limited. And then once you engage in a crowdfunding raise, there is limited annual reporting required. So basically, you just have to give a yearly update on how the company is doing, especially with how it used that money. So we've seen it used a little bit, but overall, because of its limitations, it's been fairly curbed by the SEC. And like that last graph shows a few back, it really hasn't been used all that often. So, and then so the final thing, the final major change that the Jobs Act made is it hired the amount of shareholders a private company can have before being required to go public. So this is sometimes called the Facebook law, and it basically, it's what it caused Facebook to go public earlier than it would have preferred. But basically, if a company has assets that exceed 10 million and it has shareholders, it has more than 2,000 shareholders or 500 non-accredited investor shareholders, then the SEC forces it to go public, basically. It's slightly different than an IPO, but for this conversation, they basically force the company to go public. But before the Jobs Act, instead of having 2,000, it was only 500. So if you were a private company, you had more than 500 shareholders and more than 10 million in assets, you were forced to become a public company. And so the Jobs Act raised these limits. And what it instituted is it made exclusions to what is considered a record shareholder. So if an employee receives some shares or securities in a company as part of their compensation plan, then they don't count towards this 2,000 or 500 number. So anyone who receives it as part of being paid doesn't count towards this, which before they did. And then under some limited circumstances that is unnecessarily detailed, shareholders who are part of crowdfunding. So, if you used crowdfunding to raise money, those shareholders don't count towards this number. And then if you used Regulation A Tier 2 offerings, so if anyone who bought it during a Regulation A Tier 2, they also don't count to this number. So basically, it just allows a company to raise capital through these various methods without being forced to go public, thus allowing companies potentially to stay private longer if they choose. And then, so the final slide I have here is just some of the impacts the Jobs Act may have had. It does seem plausible that Jobs Act has led to an increase in the percentages of IPOs being funded by small cap companies. Again, with all of these issues, there's a lot going on besides just the Jobs Act, but we do see a spike. Overall, however, even though more small companies have been doing IPOs, the overall IPO activity has remained fairly stagnant, and it's still much lower than what we saw before the 2000 age. So it did good at increasing small IPOs, but hasn't really affected IPO activity all around. It does seem that private capital offerings have increased. Like if we go back to this one, we just continue to see private offerings increase at a faster rate than public offerings. So it does seem like some of the exemptions made and updated with Jobs Act may have increased private capital. And then overall, the goal of Jobs Act was to spur job and economic growth. And we have seen up until this year with COVID-19 that the U.S. has enjoyed an extremely strong economic and job environment with very low unemployment since Jobs Act. So it's possible it has played a role in that. It's hard to for sure determine because, again, how much of that is specifically Jobs Act related, how much of that is just the fact that the economy was recovering from a crisis. It's hard to tell, but if you are a proponent of Jobs Act, you could make the argument that it did keep job growth strong for a very long time up until COVID. So yeah, that is all I have about the Jobs Act. Any questions or discussion?
I had a quick question.
Yep.
You mentioned in the crowdfunding slide that there would be like a max offering of 1.07 million.
Yep.
And I was wondering if you knew what the process was like for them to make that limit. Like, how do they establish that limit and say, okay, this is where it's going to be? Do you know?
I know. I can't remember if Congress was the one who initially decided that, but it's basically the SEC. Okay. I think it was originally established at 1 million, and then the SEC adjusted that up 70,000 for inflation. But that number is set, and it can be changed at any point by the SEC, depending on what they feel like doing.
Okay. So Victor, I believe that you're our discussant this morning. You want to go ahead and moderate the Q&A and offer some of your own commentary?
Yes, thank you first of all, Jaden, for a really good presentation. I really enjoyed the pace that you have there, and actually you brought out a pretty good point that companies are able throughout or because of the Jobs Act to stay private longer. But could you go a little bit deeper in that, why it is so beneficial, or why private companies want to stay private longer? What's the benefit of staying longer a private company?
That's a great question. So part of that may come as a factor of, and this probably would have been discussed if we had the other presentation, especially you look at some of the regulations like the SOX Act passed in 2003, and then for some companies, the Dodd-Frank Act following the financial crisis. And basically, it's just very burdensome to be a public company. You have significant requirements for reporting by the SEC. And so it's a very expensive and burdensome thing. But I think another reason some companies like to stay private longer is because, and I don't know to what extent this is true, but there is a little bit more control especially like a founder type person, can have in a private company. I've been doing research on a paper that actually addresses this whole thing between public and private capital. And a few articles stumbled upon the fact that when you're a private company, you have a little bit more control over what you do. You don't necessarily have to answer to the public, to thousands of shareholders like a public company does. And so a lot of founders and major investors like the aspect that they just have more control over what they're allowed to do.
Yeah, great points, Jaden. Thank you. When I wanted to ask from the class that anybody just shout out an answer if you have one, that Jaden mentioned that the emerging company is determined as a company that has less than $1 billion in revenue. Can somebody guess that what is the percentage of IPOs happening under 1 billion?
I'll take a guess at 90%.
That's exactly right, Skylar. How did you know that? You were
lucky guess.
Well, yeah. So I mean, the point what I'm making here is that the Jobs Act is defining the emerging growth companies as $1 billion in revenue. Well, that's quite a lot, and we see in the IPO market companies that has less than 250 million going into an IPO. And as Jaden showed in his presentation, that we have companies with less than 50 million going into the public market. So, but the public market is obviously feeling that they're feeling betrayed by the Jobs Act, because it's keeping the firms longer in the private equity space, the private market. So a question then for you, Jaden, that what do you think that the Jobs Act has done for the flow of funds? Meaning that where is the cash then going? Is the cash really going more towards the private space, or is this preventing the cash of going into the public space?
Great question. And really, I think it's a big function of just more capital availability in the private market. Another reason that we've seen such a growth in the private market is because returns within private investments have seen an incredible, tend to be higher than what we see in the public market. And we talked about that a little bit last class, where, the angel investors expect 10 to 100 times the return on investment. Venture capital, you expect 5 to 10. PE, you expect somewhere also 5 to 10. So we just see that when you get into the public market, 35% is seen as a wildly great investment, where 5 to 10 is 500 to 1,000%. And so one thing we're seeing as regulations have allowed more investment to go into the private market, more people have tried to stay in that arena because the returns tend to be substantially higher, although albeit riskier. There's no question that it's riskier within that private market.
Yeah. Great answer. Then just to sort of what I wanted to discuss about that, did you find in your research anything that was reflecting to what happened with the days that a company wanted to do an IPO, what the Jobs Act did, that did you see in your research that how it made faster the process for a private company to actually go public? That, as you mentioned before, the Jobs Act is limiting the amount of data what they need to provide for investors and from the SEC. So did you find anything in your research that was maybe indicating less time to analyze IPOs?
It's a great question. I'm not 100% sure. One of the reasons it can be, one of the reasons for that is the fact that with the confidential drafts to the SEC, those aren't made publicly available. So getting some of that data can be hard, because, if a company submits that draft, does a test of waters and decides not to go public, we won't ever know. Like there's no way to track the number of companies that have done that. And so I haven't found anything related to that specifically. One thing I do know, and I didn't talk about at all in this presentation, just for the sake of time and conversation, is the Jobs Act in 2003. I think there was something called the Global Settlement, and it basically it forced major investment banks to separate their analyst side of things, so like an IPO underwriter and the actual investment banking. The Jobs Act actually eliminated some of those separations and made it easier for these big investment bank companies to cover IPOs. And so it is possible that there has been more analyst coverage for these, which has increased the turnaround time.
Yeah. Well, I mean, from my part, you answered the questions very well. Is there something the class would like to ask Jaden or I?
So I've got a question that I'd like to throw in here for a moment. And Victor, Jade, neither of you can take this on. And this is going to be related to why we've seen companies stay public longer, or rather stay private longer, excuse me. What's the whole purpose for a company choosing to have an IPO of any kind?
I'll take this one on. There are a few arguable reasons, but the main reason a company goes public is because it's greater access to capital. Basically, the conventional wisdom would state you stay private until you have outgrown the private market and you have to do an IPO to raise enough money.
So, and I agree with that, of course. So if we think about companies staying private longer, are we saying that they don't have as much need for capital than as companies previously had? Because they aren't doing the IPOs to gather that capital.
I would argue that it's also a function of the interest rates being so low for the last 6-7 years that private companies have also been able to raise money through issuing bonds or getting debt from the banks, and I think that's a big part of it.
Well, and I would agree with that, and I'd extend it to the discussion that we're having here about the Jobs Act and the private and public pendulum, if you will. So think about this for a moment. If an IPO was traditionally the way a company gained access to significant sums of capital, more so than they could previously gather in the private markets, and if regulations like the Jobs Act have made it easier to capture money from both private and quasi-public investment, and if we have increased capital availability because, as Victor has told us, lower interest rates, that means that these private companies are able to attract significant capital without having to go public. And that's a lot of the point. So Jaden did a good job in trying to tell us not necessarily what the benefits of being private were, but what some of the disadvantages of being public were. The additional regulatory scrutiny, the cost of regulation and such, or complying with the regulations and the reporting and such. So this is very interesting. In fact, I'll tell you guys that Jaden and another student by the name of Britton Woodward and Griffin Ferrigno are involved in a research project right now where they're looking at all the motivating causes of some of the disparities between the private and public market activity. Jaden, would you go back to the graph where you were showing the percentage of firms in blue that had public transactions versus private? This one. So it looks here like just a couple of years before the Jobs Act came into play, which was in 2012. So just a couple of years before that, 2009, we had the vast majority of companies seeking transactions, seeking them through the public marketplace. So it was like, what, 90%, right? That's a lot of companies. Why did we see so few companies able to gather private capital in 2009?
Well, obviously the financial crisis is a big part there.
Okay, so but it looks, based on this graph, it doesn't look like the financial crisis made it hard for public companies. What am I missing here?
What you're missing is that there was merely any IPOs happening at that time, and the IPOs that were happening were some of the large companies doing it.
Very good. So when we look at a graphic like this, guys, it's all based on percentages. You have to stop and remember that 100% or 90% sounds like a big number, but it may be 90% of a very small number. And we had capital and liquidity constraints, and the capital markets had virtually seized up by 2009. And so there were very few transactions happening, period. And it was even harder for a private firm to get access to capital than it was a public. And that's because private firms have greater risk associated with them than publics at the time, or at least that's certainly the perception. And the Jobs Act kind of helped with this, but the Jobs Act wasn't simply a response to this. The Jobs Act is a movement along a trajectory towards less and less regulation over the capital markets. Well, Jayden, nicely done, and Victor, thank you for leading us through that period.